So just to understand, so when Tiger led in January of this year a $200 million round at a $1.3 billion valuation in this, that's they're getting access to the monetary mechanism for Nova Labs itself is basically I don't know if you'll probably dispute the term tax, but it's some uh, incentive on top of the existing ecosystem for having done the work to set this up and all the different mechanisms. And then that number goes down over time as the network scales.
That is correct. By buying equity in Nova Labs, Tiger bought some amount of HNT. I think they bought some HNT off of Nova Labs' balance sheet directly. And they also bought equity in Nova Labs. And Nova Labs has some plans on providing value-added services on top of the network. So things like taking your credit card and swiping it and having it all work magically, that the network cannot do that itself. So companies like Nova Labs will do stuff like that.
Yeah, you kind of get this like interesting. I mean, the financing mechanisms are compelling, if you will, as an investor, right? Because you basically have an opportunity, if you so choose, and I am extremely impressed and kind of commend you guys for being long-term holders and the fact you've never sold any of this stuff, because that probably puts you at like the top 1% of conviction actually out there. But for a lot of the folks where traditionally in a startup, if you finance like a large equity round, your ability to actually get any money out of that financing, it requires like some future M&A event or IPO. It's like totally illiquid, basically, and you take on that long-term risk. Here, some of that long-term risk is like somewhat mitigated by the opportunity to have some of your holdings in these coins. And if you so choose, and obviously you guys aren't doing this, but like if you so choose, you can essentially sell some of your equity early. It's almost like being able to access private markets for a private company stock in a slightly different mechanism, right? Like you get some liquidity for your initial investment. At least as an investor, that's how I think about it. It's like a risk reduction mechanism. Is that fair to say?
Yeah, I mean, this is a separate and very long sort of discussion about like the nature of laws around capital formation and issuing securities and financial control. What's it called? Uh, Whatever, financial protection, and the implications on liquidity and financial markets, and what that means for tech startups and innovation in the economy. Like, there's a whole bunch of interrelated issues here. I have some fairly pointed opinions on all of them. Um, but yes, you are correct. Like, this clearly reduces risk of early stage venture financing, um, in a very obvious and direct way.
I know people think I like have like a super strong opinion about this, but like I actually would admit that I'm like particularly conflicted because on one hand, you know, you can dress it up as you've got sophisticated investors who are taking advantage of unsophisticated investors in like a speculative nature, and that's not right or what, I don't know. There's like some, obviously there's some objections there. On the other hand, there are these very odd rules that, in terms of like accredited investor status and minimum income that you have to be able to participate in this ecosystem in the first place. And it's kind of like, is big brother government helping or hurting? And I think that's a very reasonable debate, right? Like a normal person who owns, one of these helium devices is unlikely to qualify in the United States to legally buy helium equity in a private financing round. But here, they can participate by buying access to the token. And like, should we just allow adults to be adults and like invest in things that they want to invest in and lose money and make money in the way that we want them to? And like, this is just another way of letting them do that. Like, I think that's actually an interesting, compelling argument. And I could see both sides to it.
Yeah. So a few comments there. One, what's particularly interesting about the Helium network is not only is it like you're raising money from the public, but more importantly, you are actually building physical infrastructure, and the public is building the physical infrastructure. So it's not just financial capital that's being formed; it's also functional utility capital in the physical world.
Oh, it's like useful money. Totally agree. It's like being spent on actual stuff. Yeah.
Right. On actual stuff, which is super cool. It happens to be tied to this also novel form of capital formation. Second comment that the more kind of directly addresses what you're saying is, basically all of the major securities laws that matter were written either in the Great Depression or in the wake of the Great Depression. And there were obviously, because of the Great Depression, lots of people were trying to scam other people to get money to live and survive and stuff. Obviously, there will always be scammers in the world. You can't really change that. But by far the most important thing that has changed between the 30s and now is the internet, and the access to information and the access to financial literacy. I think that should actually reshape how we as a society think about what risks are acceptable for normal people to take. I would actually argue it's probably good for most 18 to 25-year-olds to get scammed and lose the substantial majority of their life savings. Like, I actually think society would be better off in the long run if that happened to most 18 to 25-year-olds, because they will teach them a lesson about risk and about trust and due diligence that, like, they are never going to forget.
It's hard to disagree. I mean, it's a very libertarian take, obviously, of like people are adults and let them make their own decisions. Yeah, there's a really nice life lesson of getting screwed over early in life and realizing like maybe I should like triple check this before I put a bunch of money into it. I totally agree.
Yeah. I think society as a whole would be, I think that would cause people to make much wiser decisions around all kinds of other facets of their life, if they experience that where the absolute dollars are quite small.
Yeah, one of the biggest critiques I think crypto investors and operators have of the US system that I actually do agree with is that we have a lot of these consumer protections, and I want to use it broadly, but very specifically like accredited investor and qualified purchaser standards, right? Which is basically like an income and asset requirement that you have to be able to invest in private company stock. You have to have made something, I don't remember it offhand, but I think it's like something like at a minimum $250,000 a year for a few years, or have something like $1 million in underlying assets, like non-house, whatever. It's like a reasonably big number. And if you don't have that income or assets, you basically can't participate in private equity financings of C Corps. It's a little crazy.
Correct. I would actually argue the problem is worse than that. It's not only the accredited investor rules, as you're alluding to, it's also the fact that the assets are structurally illiquid for such a long period of time. Like, one thing is, hey, your income is $400,000 a year, but like a lot of people who make $400,000 a year are unwilling to part with $50,000 if they believe there's no chance they'll get it back for a minimum of 3 years, or longer. And if you can actually reduce time to liquidity, you open access to financial markets, but because it just is a function of risk tolerance and risk preference. Now that I realize that introduces its own new problems, and I don't dispute that, like, that comes, like, insider information and other kinds of problems become a thing. But like, again, I think society is probably better off in the long run if people can be adults and if people can go in and out of stuff as they see fit. Telling people you cannot invest in things that you believe in, like, because they're just illiquid and inaccessible. Like, if the founders genuinely believe the product or service or the community or whatever is better off by enabling people to become economic owners in it on some free market, like, we as a society should generally optimize for that to be a thing.
I don't think it's the liquidity piece of it. Like, I think there's a lot of really sound arguments about why liquidity in private companies, especially growth stage private companies, is actually a bad thing for the company, because you have massive variability in the price. It moves up and down. It's hard for the employee base. It's hard to recruit. It's hard to retain. You're constantly resetting your stock options. It creates somewhat of like an operating nightmare for founders of these companies. Like, there's a reason why they're staying private for a fairly long time by choice. Like, if you ask any seasoned founder operator, they would tell you, like, I will go public when I believe my stock price will remain reasonably stable over time, because my employee happiness trends almost exclusively to the stock price. I've talked to like enough public market founders where you ask, like, how does your employee feedback look? And they go, well, what does the stock price look like? Because it literally attaches itself to the stock price. And there's some real downsides. I got in this stupid shouting match with Sam Lesson about liquidity, and he's like, very religious. It's a feature. It's always better. I'm like, that is just like not true if you're a founder operator, and it will hamstring quite a few companies from growing. So I don't buy the like liquidity is necessarily a good thing for the company. I agree that the protectionist rules that we have in place that stem from, some really bad actors where information was not nearly as readily available probably are outdated and should be revised. And, we should allow people to take a little bit more risk on their own dollars and get access to, interesting startups. And this is one kind of somewhat clever way of doing it for kind of a niche use case. The liquidity one, I think, is a whole separate challenge, but they tend to get related. I don't think the liquidity argument holds in my book. I do agree the big brother nature of this, or like the protectionist nature of like the government is here to protect you from making really bad mistakes. That doesn't always sit right with me. I think people should be allowed to make dumb mistakes on their own.
Yeah, I mean, one thing crypto is by enabling the public at large to become economic, shared economic interest in your outcome, that is a very powerful thing to unlock.
We are watching this happen live, right? By the way, to be really clear, like we are watching the lack of rules have two very different outcomes, right? We have the helium outcome where you've got this like infrastructure build out because consumers are taking on risk, now much smaller dollar risk, $50, $200, $500 risk. They're buying hardware, they're plugging it in, they're effectively investing. They're just doing it in this like slightly different way at fairly small dollar amounts. And you get to see this like infrastructure build out because there are no rules, right? They're allowed to do it. And that's like one end of the spectrum. And then you do have the other end of the spectrum, which are like the scams and the Ponzi schemes and the blowups, and like both are happening at the same time. We're like watching the lack of regulation play out, and it's kind of fascinating to see what happens there because this is the lawless version of finance that we had a while ago, and there's probably some balance between these two that is where it should end up. It should not be like completely open for anybody to start a crypto project and raise money and allow consumers to buy it at the same time. Yeah, $250,000 a year in income for a few years is probably a little too high of a minimum for like the average American. I think that's a little crazy.
Yeah, and then there's also the question of, well, what about non-Americans, right? Like, can you want to enable random guys and pick your country of choice to get excited and participate, and to do so at much smaller dollar scales?
Yeah.
Well, this is good stuff. I know we only blocked this amount of time. Kyle, thanks for doing this and going through all of this stuff. It's a lot of interesting stuff going on, and we appreciate you sort of answering our questions throughout here.
Wait, can I ask? I have to ask because we done the Bitcoin stuff, and so I always like to ask the Bitcoin people their impression of like the more crypto oriented business models, and then the crypto people the Bitcoin question. Where do you net out? You kind of alluded to it earlier, the whole like Austrian economic thing, but I'm curious your stance.
I think Bitcoin is absolute nonsense.
I knew we would get a strong opinion. That's what I was hoping for.
Can you elaborate? We need this. We need some hot clip right now for the Bitcoin maxis out there.
I mean, this clip went viral like a week ago from Harry Stebbings' podcast, in which I said, quote, "Bitcoin is nonsense." So, I'm just rehashing what I said like a week or two ago.
That's fine. Yeah, we need our own virality. We can play the game.
Our overlap of his thousands of users is like two guys in their basement listening to this.
Yeah, exactly. You got only 15 people listen to this, so yeah.
Right. So, the quick of it is that Bitcoin is supposed to be an inflation hedge. Bitcoin is explicitly a non-productive asset. If you are genuinely trying to hedge inflation, there's a whole array of assets you can buy that are productive assets that even if their PE ratios go to 1,000 or even to 1,000,000, they still have a yield greater than 0. And Bitcoin's yield will always be negative, at least until the year 2140, because like there's still Bitcoin being printed. And Bitcoin has no pretend semblance of ever having a positive yield because it doesn't do that. My therefore contentions is there is no point in having non-productive assets. Commodities obviously have some sort of functional utility value or whatever, it's fine. But like, there is no bar that like I have derived that you actually justifies holding a non-productive asset when like, if you want to avoid inflation, the right assets to buy are like Amazon or like Walmart or like Tips or whatever. There's 500 things you can choose from.
Something with an income stream, basically.
Something with an income stream and something that is like clearly inflation resistant, and you can just buy a basket of those things to hedge out any specific idiosyncratic risks. But arguing that like we need gold, but the rock in the ground, or in this case, the digital version of the rock in the ground, is like clearly the incorrect answer when you can have something that's productive instead.
Totally agree. The only bull case I've heard, and we had this combo with Pomp at one point. And it's not even like a good bull case. It's just like a logical bull case. Good meaning like fundamentally agree with it. It's more of a time in history was, well, other people perceive it to be a good investment. And so like there's a time for when you should own it because other people perceive it to be worth holding. And like there's this, it's like a trading view of it basically, but I couldn't agree more. Like in a long-term hold, like it's totally unproductive asset. It has no income stream whatsoever. It never will. Now it begs the question, why do people own gold? And obviously gold has like this big history, and you know, I also would not own gold myself, but very, very, very aligned on that front. Logan holds it because he doesn't want to look like an idiot. So,
Well, I'm going to look like an idiot either way. I just want to have some hedge no matter what, that I can say I'm right.
Broken clock is right twice a day.
Right. That's right. Kyle, thanks for doing this. Thanks for coming on.
All right, guys, take care. Good to talk.